the cost of a mortgage is obviously not as accessible as it was historically. I've personally advised on 55,000 build-to-rent units over the course of the last 10 years. There are build-to-rent schemes out there with no concierge and no amenity space, and they probably didn't make any big headlines when the deals were done, and they rent really well because we've got a supply and demand imbalance, but we'll come on to that in a bit. Hi, I'm Polly Simpson. I'm head of Multifamily Development at Savills.
From Ackroyd Lowry, I'm Oliver Lowry.
And I'm John Ackroyd.
And this is Urban Forecast, the show where we talk to the people defining the future of our cities. We discuss their background, what drives them, and the insights they've learned along the way.
This is a podcast for anyone who's interested in how we live, work or play in the cities of the future, and what that means for the built environment today.
Polly, thank you so much for coming on the podcast. And often I start these podcasts by asking people their journey and their background. But in this particular instance, I'm going to mix it up. And I want you to talk about the journey of build to rent.
The journey of build to rent has been a hugely exciting rollercoaster. Build to rent probably has existed in the UK for the last decade and started with a few institutional investors diversifying their real estate holdings into more away from the traditional real estate asset classes. But there wasn't really a sector and a load of operational product for them to buy, so they started developing it via forward funding transactions, culminating in the first deal, which was M&G, and really the trailblazers in the sector leading the way at the rehearsal rooms in North Acton in a partnership we brokered with Hub. And that kind of became the blueprint for how institutions were interacting in the sector. And roll on 10 years, we've delivered 88,000 operational assets across the UK, 38,000 of those in London and the remainder across regions. And the balance of that is switching more towards regional development than it was at the beginning. But there's been a lot of challenges along the way, and much like all development, with first of all, Carillion, we're on a lot of build-to-rent schemes, and there was construction challenges, Brexit, then COVID, and all of that has taught us a whole number of things about the rental market and how tenants want to interact and with the places that they live.
Thank you. That was a great oversight. And I think so. I think you've listened to, and we had Ashley Perry recently talking about build to rent as, a developer of it and an investor in it. It would be good to just get a bit of an overview of your role and actually talk about how you did get, your background and how obviously your role differs from Ashley, who is one of the people actually developing.
Yeah, my role is very different, and I'm very accidentally in build to rent as well. So I joined the Savills grad scheme almost a decade ago to this day. And on a rotation, I accidentally ended up in what would become the build to rent team, not really knowing very much about the sector, but nor did anyone at that time. So it was completely fine, and have never really looked back. My background was in planning, which has been a hugely important insight into how we can navigate what I consider to be some of the key challenges of delivering more institutional grade product for rent at scale fast, which has been incredibly useful, but in our role as transaction brokers. But our journey, or our kind of role in build to rent development, starts very much earlier on. So from concept, what product goes where, why, and in a specific location. And then through the journey through planning, and which can be quite challenging, and then ultimately sourcing, or on behalf of developers, institutional and investors like Ashley, into forward funding, or on the acquisition side, advising investors on structuring deals with developers.
And so 10 years ago, when you walked into the Savills office and you were on the rotation that ended up leading you into build to rent, was that because you were working on that initial M&G deal?
We did broker that initial deal, but no, that was all. I joined a team full of incredible people who are all still industry leaders in build to rent, but majority of which have moved on to the developer or investor side at the moment, and they were pioneering in the space. My job was changing the logos on the front of a business case for why people should invest in build to rent, and we'd go around to major global sources of capital and present to them about why residential was a great space to put money. And everyone would say, yeah, I mean, you make a good case, but we're just going to buy offices. So, and it was tough actually, but eventually there's one by one, and the capital kind of saw what we did, and opportunities presented themselves as well. So I think that it was a great theoretical place to be, but without really having something to kind of analyze or get stuck into, it was quite a very difficult sell. So when we started to convince developers to also do the same thing, it was marrying the two became a little bit easier.
So recently you also had Paul Wellman and James Hammer from Savills talking about co-living, and obviously co-living I think is kind
the
of
new buzzword. The new buzzword.
It's sort of a subset of build to rent. Some people would say, including them, I think. We were talking about how that was a very nascent sector, and therefore that sort of explains why there's only 3,500 operational beds in the UK. But actually, the collective probably started developing co-living 5-6 years ago. Similar time, maybe even longer ago. Build to rent seems to have accelerated much faster. Is that because it's got a larger total addressable market? Or is it because investors understood it more quickly? Is it because the planning system is geared towards build to rent more easily than it is towards co-living, which is sort of slightly, people have to use their imaginations to work out what it is? What's your analysis?
I think it probably, and co-living's got huge potential, and I think that it's attracting more and more institutional investment. But the reason it kind of, I guess the reason it probably hasn't continued on the same or with the same velocity as build to rent is absolutely to do with availability of product, but also the fact that build to rent's a bit more relatable. I think that was it. It's, the concept of residential for rent was much easier to prove its success of through outperformance of operational assets than when you had one, which was the collective up at Old Oak, and every other co-living scheme that was kind of conceived around that time really struggled through planning. And so it wasn't really able to get going to generate the momentum to prove that actually people do want to live in this kind of environment. Whereas build to rent, with exceptions, is largely the same as a typical buy-to-let block of flats. I mean, it's got from a kind of ultimate product place in terms of what is your space. Obviously, there are services and amenities, or there can be services and amenities that differentiate it further. But generally speaking, the principle is one that was accepted. This product is something that people are used to living in and like to live in, and therefore it's not so much of a risk. I think we're still seeing that as well in the types of capital that's investing in co-living versus build to rent. So there's not a whole lot of overlap between build to rent and student and purpose-built student accommodation, and there is overlap between a couple of parties in co-living and build to rent, but far more in co-living and student, which is a bit more similar product type, I think.
Yeah, and it was an interesting point just to go back on what you were saying. Is there, and Ashley was sort of keen that there was a distinction between your run-of-the-mill C3 residential developer spec housing. Can you just get planning for that, build it out, and then at the last minute decide that you want to rent the whole lot out and that be build to rent? Or is there a special formula of amenities that you need to be planned in from the start if you are bringing forward a build to rent scheme of a certain size?
So what I absolutely love about how the sector's evolved over the last 10 years is product differentiation and market segmentation. So yeah, I mean, Ashley's had an amazing track record of delivering a certain type of product for a certain group of which there is definitely demand from a tenant base in all of those locations. But actually, the market is quite varied. So you've got a whole spectrum of parties that deliver a different host of services and amenities, and sometimes very low levels of amenity space. What is fundamental more than anything for build to rent development, or kind of consistent across every type of build to rent development, is this emphasis on the management efficiencies back of house space to make sure service is better. Some don't have gyms and they don't have running tracks on the roof, but they still serve a certain portion of the local population and their rental demands. In terms of, I mean, I've personally advised on 55,000 build to rent units over the course of the last 10 years. And I would say well over probably 80%, let's go with that, 80% have not been built to rent in planning terms. They've just been an open C3 consent that you can sell or you can rent. Now that doesn't mean they don't have design features that are consistent with a build to rent scheme, but when we are kind of advising our developer clients on what the institutional market wants to see, we are rarely saying to them, that's where your gym goes and that's where your cinema should be and that's where your party room is. Every investor is very, very different in what they want to provide and what their brand.
Are you saying, because I know that, dare I mention that your competitor, CBRE, published a sort of guidelines on what the minimum requirements were for each of the kind of, like 5-star, 3-star build to rent products. And I think the minimum that it had across everything was that it did have a concierge.
Yeah,
You guys being prescriptive and saying, look, if you want to do build to rent, you really do have to have some communal facilities and a concierge and XYZ.
Yeah, I haven't read the CBRE document, but yeah, I think that the minimum now. There are two things here. So what's the minimum that tenants would expect, and what's the minimum to get best investment value that actually has your best chance of getting things viably delivered? And they are different answers. So there are build to rent schemes out there with no concierge and no amenity space, and they probably didn't make any big headlines when the deals were done, but they rent really well, and they've got a strong tenant base and they rent really well because we've got supply and demand imbalance. But we'll come on to that in a bit. But I think that right now, if you're looking for a build to rent investor to come forward fund your product, then you definitely need to show that the entrance lobby and that management concierge desk back of house space has been well conceived and designed for what the majority of investors want to deliver, which is high quality services. And the amenity side of things is price point variable. So you don't put a hot yoga room in parts of the world where the operational cost would be about 50% of the rent. So it's common sense to an extent, but it's also locally driven. People do. What I've also loved watching is how different cities regionally are responding to different design aspects of schemes, like in terms of internal in apartments, but also externally. So if you're in a place with lots of amenity outside, you're probably not going to pay premium rents for a small gym in your building. So it's important to take in consideration all factors, and I don't really think there's a rule of thumb that really works for amenity space and build to rent.
Yeah. Okay. Good answer. And so you said you would come back to the imbalance between supply and demand. Before we started, I was saying that it's like the perfect conditions for build to rent, because you've got rising rents, you've got property prices going down in terms of sales values. So you've got lots of developers going, oh, well, actually, the best option here is just to refinance and rent them out. And so it's not necessarily the perfect conditions. It's more that it's sort of becoming the only option at the end of a development cycle for people to be able to get their money back out. I don't know whether those are the same things, but yeah, do you want to talk about, first of all, the supply, and then maybe what have some of these external conditions accelerated build to rent, basically because no one can sell anything?
You've just talked through my whole
Sorry.
You want a job? No, I'm kidding. Yeah, you've absolutely nailed it. So in this kind of environment, and the reason why I think build to rent investment volumes investment has continued to attract attention over the course of the last almost exactly 12 months, has been the kind of structural position that we are with the housing market in the UK. So we don't have a housing target anymore. That was scrapped probably about a year ago as well, but when we did, we never met it, so we can't now measure underperformance. But we did consistently deliver between 216 and 247,000 homes a year against a target of 300,000. Now every year you miss that target, that just accumulates or compounds to make the supply and demand imbalance even worse. Rental growth, I think, it's got hit a lot of headlines over the course of the last 12 months, but probably since the beginning of the end of 21, really, when we saw a COVID rebound and everyone thought it was just kind of catching up, and to an extent it was, but now it's currently sitting nationally at just over 10%, which is broadly tracking wage inflation, which historically is what has happened. And we've also seen an environment whereby buy-to-let landlords, your traditional investors that would have bought homes in open market sale product or developments to rent out, have got a series of factors that dissuade them from doing so. So the rate of net buy-to-let net mortgage redemptions last year was far in excess of build-to-rent completions, which was about 10,000. And what we saw, if we look at some of the big national listing companies, was that available properties to rent were down over 30% nationally, but in comparison to their 2017 to 19 average. So you basically had over 30% fewer properties to choose from when you were renting. And yet each year we continue to not deliver enough housing, the demand increases, which is what is fueling the rental growth situation.
And the fact that at the moment it's very, if all your profit is locked into the last few units, then selling those units, risking
yeah, sorry, I didn't fully answer your question about why build to rent, why and now. Absolutely. I mean, I think that you're with the end of Help to Buy, which was obviously supporting a lot of development nationally, the cost of a mortgage is obviously not as accessible as it was historically. And even going back 18 months, I think that will prolong, or we're starting to see signs that it's prolonging decisions to buy housing and keep you remain in the rental sector even longer. And, there are build to rent buildings nationally with waiting lists that could fill the buildings twice over. So demand is strong, and all of those factors are kind of looking to are encouraging developers to look increasingly towards build to rent. Now, what I would say is not every scheme works for build to rent, and whether or not it's a last minute switch for design reasons, or it's a really expensive or an expensive product where rents in relationship to capital values just aren't there. And so we quite often say that build to rent isn't right for this site or this scheme or this location. But the tenant demand piece is there. That's more of a question of viability.
We actually met at MIFIM, and I remember this was when I first started noticing that everybody was suddenly a build to rent specialist. Every developer that would have 5 years ago said I'm a house builder was now, oh, I'm in BTR, because everyone's having to learn it. Does that mean you're very busy advising everybody now how to become build to rent specialists, or are you seeing people try and do it themselves and mess it up?
A bit of both, really. We've always been a busy team. So we started a team 10 years ago, which when build to rent, we didn't have any competition at that point. There were no other teams. So one might say first mover advantage. And it was definitely the narrative has changed to the conversations that we're having with our clients, and has definitely changed from us kind of chasing everybody down to everyone wanting to recognizing that the delivery of institutional build to rent is a really important part of the housing market in the UK right now, but also historically. Right now, but also because it has a really important part to play in housing delivery.
Well, it has a lot of sort of tarmac to eat up as well, because it only accounts for about 3% of UK stock. And if what you're saying is true, that all of these buy to let landlords, who account for approximately 30 to 40% of certainly urban population's dwellings as people renting off buy to let landlords, build to rent's going to have to pick up that slack if interest rates and the tax situation forces those people out. So it sort of needs to accelerate even faster.
You're preaching to the converted. I completely agree. So 10 years taking us to deliver 88,000 operational assets. Yes, I mean, I think if you take the total pipeline, that we get it. We're not even approaching 300,000 at the moment. And looking at the structure of housing markets in more mature institutional rental markets like the US and like Germany and other continental markets, our research team, some people far cleverer than me, have estimated that the UK has capacity for 2.1 build to rent units at its maturity. So if we're delivering on average 8,000 a year, I think we do need to definitely up the pace of delivery in order to satisfy
2.1 million.
2.1 million, yeah.
Yeah. You've got the tenant demand. You've got developers wanting to build but being unable to sell. Is the issue here that there's not enough institutional appetite to support it? Surely it should be accelerating even faster and sort of starting to eat up market share of normal C3 residential.
I think theoretically that's absolutely that is right. I think that what I would say is that build to rent isn't completely isolated from the macroeconomic challenges. Rises to interest rates has an implication on capital and has affected yields. Construction cost increases have hurt every part of the real estate development world, and build to rent isn't absolved from that. So in theory, yes, we should be taking up a greater share. In fact, we are, in terms of starts on site build to rent versus open market sales for this year in urban locations is something like 30 to 40%, depending on which city you're in. Historically, build to rent's hovered between 8 and 9% of all starts on site nationally. It's currently sitting at 13%. And which is encouraging. And do I think that institutional appetite or sentiment has shifted dramatically over the course of last year? No, I think the support for the sector is still there and is as strong now, if not stronger, than it's ever been. Finding deals that are deliverable and that have the counterparty covenant strength and planning which meets regulation, which is changing, I'm sure you know, from a design perspective, has really slowed progress throughout the course of this year, having to amend almost every planning application that was no longer compliant with new building regulations and Building Safety Act issues, has slowed everything. So in terms of what we've seen over the course of the last 12 months is every year pretty much Build to Rent has had a record-breaking year for capital deployed into the space. Last year was about 4.5 billion, well, was 4.5 billion, 50 transactions, 33 different investors, and 11 of those were brand new. So that is about 33% of new entrants to the market, which is actually consistent with every single year. The majority of new entrants coming from North America or the UK. This year we had a pretty slow start, to be honest. 820 million in Q1 was one of the lowest quarters of capital deployed into Build to Rent. But then Q2 was the strongest ever Q2 for capital and for deals to happen. And so I think that, and all of those things reflect sentiment, maybe 6 to 9 months pre-sentiment, but ability to transact 6 to 9 months earlier, because that's how long it takes to do deals. And so Q3 has been quite quiet. Everyone seems to have been on holiday for August, but we're going to probably end up with a Q3 that's broadly in line with last year's Q3, so just under $1 billion. So whilst I was asked at the beginning of the year what I thought, and I predicted Build to Rent would have a record-breaking year this year, I think in context it will, in context of capital deployed into real estate allocated to the living sector or allocated specifically to Build to Rent, I think this will be a record-breaking year. I don't think we'll get to 4.5 billion. So the sector isn't growing, but I do expect us to hit 4.
It sounds like, a sort of unstoppable trajectory for Build to Rent. Is there anything with a potential change in administration next year that you think might stifle the sector with Labour coming in?
The talk of political change and what that means explicitly for rental growth or controlled rental growth had been a massive topic for the sector for years to come. Lots of speculation, but relatively unfounded. I think we're in a bit more of a positive position now, knowing that neither of the main two political parties are going to advocate for rent controls in their manifestos when it comes to campaigning. Now, that's not that I'm supporting obscene rental growth. I rent in London and my rent went up a ridiculous amount last year. But what I do think is that the only way to really combat rental growth, which is unsustainable, is through increasing supply. And any sort of barrier to investment or to delivery, like we saw in Scotland when they brought the rent freeze in, and which I think is going to have such long-lasting repercussions on the housing market there, is extremely dangerous and detrimental to housing delivery in the UK.
Good thing to end on. Polly, thank you so much for your time. It's been an absolute pleasure, and I'll catch up with you soon. Thank you.
Thanks, bye.
If you enjoyed the show, then please subscribe and give us a review, ideally a 5-star one. And if you want to know more, please go to ackroydlowry.com or follow us on Twitter @ackroydlowry and Instagram with the same. This podcast supports Land Aid, the property industry charity that brings together the sector to deliver life-changing projects for young people who really need it. Visit www.landaid.org to find out how you can help end youth homelessness.